Eli Lilly just reported its first quarter for fiscal year 2026. Revenue grew 56% year over year, net income tripled. The company raised full-year guidance by $2 billion. The stock jumped almost 10% in a single day, adding $80 billion to market cap. But here's the question this video tries to answer. After such a quarter, what kind of premium does the market deserve to pay for hypergrowth? And where exactly are the cracks? Let us start with the headline metrics. Revenue came in at $19.8 billion, up 55.5% versus the same quarter last year. Net income reached $7.4 billion, a 168% jump. GAAP earnings per share were $8.26. Non-GAAP came in at $8.55. Versus consensus, Lilly beat revenue expectations by 13.7% and earnings per share by nearly 25%. And then management did the thing analysts wait for. They raised full-year guidance. Revenue range moved from $80 to $83 billion up to $82 to $85 billion. Earnings per share moved from a midpoint near $34 up to a midpoint of $36.25. This is not just a beat. It is a confident signal that the second half should accelerate, not slow down. Now look under the hood at operating leverage. Revenue grew 55.5%. Operating income grew 141%. That is a leverage ratio of 2.5 times, meaning every dollar of incremental revenue is producing more than $2 of incremental operating profit. Operating margin expanded from 29% to 45%, a 16 percentage point lift in 12 months. But there are two caveats. Gross margin actually slipped slightly from 82.5% down to 81.9%, driven by lower realized prices on Zepbound, Taltz, and Mounjaro in China after the national reimbursed drug list deal. And the effective tax rate dropped from 20.2% to 16.4%, partly thanks to a much smaller non-deductible IPR&D charge versus the year-ago Scorpion Therapeutics deal. So part of the earnings beat is structural, but a real piece is from a lower tax rate that may normalize back to 18 or 19% later this year. Cash flow tells a more nuanced story. And here's the simple version before the numbers. Lilly is spending more cash than it earns right now, intentionally and at massive scale. Operating cash flow came in at $5.3 billion, up 220% year over year. Capital expenditure was $2.3 billion, almost 12% of revenue, funding the global manufacturing build-out for incretins. That left free cash flow at $3 billion, up from just $156 million a year ago. But here is the watch item. Operating cash flow as a share of net income was only 72%. The reason is working capital. Accounts receivable rose $669 million sequentially, and inventories rose $785 million as Lilly stockpiles for Foundayo launch and the Mounjaro global ramp. The balance sheet, by contrast, looks pristine. Net debt to EBITDA is just 1.01 times. Interest coverage is 27 times. The investment is deliberate, and the dry powder to support it is real. Now the structural risk that frames everything. Two products, Mounjaro and Zepbound, together generated nearly $13 billion this quarter. That is 65% of total revenue. 1 year ago, that combined share was 48%. So in 12 months, concentration jumped 16 percentage points. Mounjaro grew 125%, with the international piece exploding 274% thanks to global launches and the China NRDL deal. Zepbound grew 80%, but it is still 99% a US story. And Trulicity, the legacy diabetes drug, declined 16%, cannibalized by Mounjaro. This is healthy cannibalization in revenue terms because Mounjaro generates much more per patient. But it tells you exactly how dependent Lilly is on the two drugs hitting their numbers every quarter. If a competitor like oral semaglutide from Novo or Pfizer's danuglipron or Roche's petrelintide breaks through, the impact would be immediate and material. Geography is where the growth engine is most visible and where one number stands out. Rest of world revenue, emerging markets like India, Brazil, Mexico, the Middle East, grew 178%. Think about that. Markets that barely registered on Lilly's map 12 months ago are now one of the fastest growing revenue lines in big pharma. The US contributed $12.1 billion, up 43%. Outside the US, revenue jumped 81% to $7.7 billion, driven primarily by volume up 95%. China grew 54% despite the national reimbursed drug list pricing concession that effectively cut Mounjaro pricing by roughly half. So, volume is doing the heavy lifting. The total revenue bridge is plus 65% volume, minus 13% price, plus 4% foreign exchange. The GLP-1 global rollout is a volume game and Lilly is winning it, but only as long as the price-volume trade-off remains favorable. Now what could go wrong? 6 risk factors. First, concentration. 65% of revenue from 2 drugs is high severity. A competitive setback hits hard. Second, working capital. Cash conversion at 72% is below parity, with inventories building. Third, asymmetric pricing. Outside U.S. prices fell 25% this quarter, and the Medicare Bridge program will pressure U.S. obesity pricing. Fourth, litigation. Insulin pricing multi-district litigation, the 340B program disputes, the Strive Specialties antitrust suit, and the average manufacturer price qui tam case all remain active. Lilly recognized a $279 million litigation charge this quarter alone. Fifth, Foundayo execution. Week 2 prescriptions came in at 3,700 versus Wegovy's launch at over 18,000. The early signal is modest, and every quarter of slow ramp raises the question of whether the oral format is truly a mass-market product or a niche one. Sixth, pipeline timing. Most readouts are concentrated in 2027 and beyond. There is no real second leg between now and then on Mounjaro, Zepbound, and Foundayo. Every quarter until those readouts, the company runs on execution of existing assets. Now to the pipeline that needs to deliver. Foundayo, formerly orforglipron, is the first oral GLP-1 pill that does not require food or water restrictions. The FDA approved it in April. The Phase 3 ACHIEVE-4 trial, the longest Phase 3 of orforglipron to date, reaffirmed cardiovascular safety and consistent improvements across cardiometabolic measures in adults with obesity at increased cardiovascular risk. First revenues come in the second quarter. Analyst forecasts for fiscal year 2026 range from $1.3 billion at the conservative end to $2.8 billion at the high end. Then there is Retatrutide, the triple agonist hitting GIP, GLP-1, and glucagon receptors. The TRIUMPH-4 trial delivered 28.7% weight loss, the highest ever recorded in a Phase 3 obesity trial. 75.8% reduction in knee osteoarthritis pain. The first Phase 3 type 2 diabetes trial succeeded in March. 7 additional Phase 3 readouts are pending in the fourth quarter and beyond, covering obesity, obstructive sleep apnea, MASH, heart failure with preserved ejection fraction, and cardiovascular outcomes. Peak sales forecasts run as high as $15.6 billion by 2031. Here is the catalyst calendar to watch. In the second quarter, the first Foundayo prescription data. That is the early adoption signal everyone is watching. In July, the Medicare Bridge program goes live. Discount uptake by Medicare beneficiaries is unknown. In the second half, 7 Retatrutide Phase 3 readouts will be pipeline defining. On December 7th of this year, Lilly hosts an investment community meeting where long-term vision and capacity build-out should be quantified. Looking further out, 2028 brings 2 important events. Trulicity and Verzenio enter Medicare price negotiation under the Inflation Reduction Act, which will be an earnings headwind. And Retatrutide is expected to receive FDA approval, which would be category-defining.